Here is a fact that has stunned economists across the continent. In 2025, Spain's economy grew by roughly 2.8%, while the Eurozone as a whole managed barely 1.3 to 1.5%. That means Spain expanded almost 3 times faster than the currency union it belongs to. Germany, Europe's traditional powerhouse, grew just 0.4%. France crawled along at around 1.1%. So how did a country once dismissed as part of the so-called fragile southern periphery become the locomotive pulling Europe forward? And more importantly, what does Spain's financial health actually mean for the wider European Union? In this video we will analyze exactly how Spain's finances ripple outward, shaping the euro, the bloc's growth figures, its banking system, and its budget politics. Because when the fourth largest economy in the Eurozone shifts gear, the whole of Europe feels the movement. To understand Spain's influence, you first have to grasp its sheer size. Spain is the fourth largest economy in the euro area, behind only Germany, France, and Italy, with annual output worth well over €1.5 trillion. It is home to around 48 million people and has used the euro as its currency since the notes and coins entered circulation in 2002. Because the Eurozone's headline growth number is a weighted average of its members, a large, fast-growing Spain mathematically lifts the entire bloc's performance. When analysts reported that the Eurozone narrowly avoided stagnation, much of that resilience came from the south. Put simply, Spain is now doing the heavy lifting that Germany used to do. That structural shift matters because Brussels, the European Central Bank, and global investors all watch the aggregate Eurozone figure, and Spain is quietly propping it up. So what is fueling this growth, and is it built on solid ground? The main engine has been domestic demand. In late 2025, household consumption rose strongly and investment jumped by close to 2% in a single quarter, showing genuine confidence among businesses and families. A surge in immigration has expanded the labor force, filling jobs in services, construction, and care work, which directly adds to output. Falling energy prices have helped too, since Spain was hit hard by the 2022 energy shock and has rebounded as costs eased. However, there is an important caveat that serious analysts keep flagging: much of this is quantity-driven rather than quality-driven growth. Labor productivity per hour has barely improved. In other words, Spain is growing because more people are working more hours, not necessarily because each worker is producing more. That distinction will matter enormously for the years ahead. One of the most direct ways Spain links into EU finance is through the NextGenerationEU Recovery Fund, the massive package created after the pandemic. Spain is one of the single largest beneficiaries of this scheme, allocated a headline figure of more than €160 billion in grants and loans. This money flows into green energy projects, railways, digitalization, and skills training. Here is the crucial point for our analysis: these funds are partly financed by joint EU borrowing, debt issued in the name of the entire Union. That means how effectively Spain spends its allocation is not just a Spanish question. If Madrid deploys the money well and growth follows, it strengthens the credibility of common European debt as a financial instrument. If the funds are wasted or absorbed too slowly, it undermines confidence in the whole shared borrowing experiment that many see as the future of EU fiscal integration. Spain's influence is not only about national output. It also runs through some of Europe's biggest financial institutions. Banco Santander and BBVA are genuine global heavyweights, with Santander ranking among the largest banks in the Eurozone by assets and serving well over 150 million customers worldwide. These banks are deeply woven into the European financial system, holding government bonds, lending across borders, and moving capital throughout the single market. When Spanish banks are healthy and profitable, they help stabilize the Eurozone's banking union. When they wobble, as the country learned painfully during its 2012 banking crisis that required a European bailout of up to €100 billion, the shockwaves spread fast. Today the picture is far stronger, with rising interest rates having boosted bank profits, but the lesson is permanent: Spain's financial sector is a transmission channel that can carry either confidence or contagion across Europe. Now consider Spain's role in Europe's trade and current account. Spain is one of the most visited countries on Earth, welcoming record numbers of international tourists, with annual arrivals having pushed beyond 90 million. Tourism alone accounts for over 12% of Spanish economic output, and a huge share of those visitors come from fellow EU nations like Germany and France. This generates a steady stream of foreign currency and helps Spain run a healthy external position, which in turn supports the euro's stability. A country that earns more from abroad than it spends strengthens the bloc's overall balance of payments. So every German family holidaying on the Costa del Sol, every French traveler in Barcelona, is part of an inter-European financial flow that quietly reinforces the Eurozone's collective accounts and reduces its reliance on outside capital. But we must be honest about the vulnerabilities, because Spain's influence on EU finance can be negative as well as positive. Public debt remains high, hovering around or above 100% of GDP, well over the European Union's official 60% reference limit. The European Commission has reactivated its fiscal rules, meaning Madrid is under renewed pressure to bring its deficit and debt under control. Youth unemployment, though falling, has historically been among the worst in the developed world. And that productivity weakness we mentioned earlier means today's fast growth may not be sustainable once the immigration boost and recovery funds fade after 2026. If Spain stumbles, it would drag down the Eurozone average and could revive old fears about southern European debt that haunted the bloc during the sovereign debt crisis. Spain's strength, in short, is real but not guaranteed. So let us pull the threads together. Spain influences EU finance through four powerful channels: its sheer size lifting the Eurozone's growth average, its status as a major recipient testing the credibility of joint European debt, its global banks acting as conduits of stability or risk, and its tourism-driven surplus reinforcing the euro itself. As of June 2026, Spain is forecast to keep growing above 2%, while Germany and France lag far behind. That makes it, for now, the unlikely engine of European recovery. The real question for the years ahead is whether Spain can convert quantity into quality, raising productivity and taming its debt before the tailwinds fade. If it succeeds, it offers a blueprint for the whole continent. If it fails, Europe loses its brightest growth story. Either way, to understand the future of EU finance, you now have to watch Spain.